Welcome to the Crypto Teacher. And guys, you know I come back with that second video just to make you think. And of course, this is on Jim Cramer. And the reason why I'm going over this, guys, because of course we're about to run into another storm. And when it comes to this, guys, people actually trust him. And we all know whatever he say, do the opposite. Now remember Bear Stearns. And then also remember Goldman Sachs. Of course, remember he's a Goldman Sachs alumni. And I've shown you the video of how he hustled Apple down. And we see right now, in the media right now, they're talking Apple down. But of course, I'm going to speak about that on the stock market channel. But the fact is, guys, Jim Cramer is one of the biggest hustlers. Do not fall for it. I've done plenty of videos on it. But we have to realize that we are headed into a crisis. You have to do your own research, your own reading, and then you go with other people's opinions. But y'all enjoy the video.
Back. What am I supposed to just say? Hey, great job? All right, anyway. Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is real. If there's one takeaway other than the plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly. Bear money's back after the break.
Welcome back, everyone. It's time for Stop Trading. Jim Cramer is here. Jim, lot to talk about today. Bear Stearns first, and I know you and I were just talking in the commercial about this letter that you got. It said, Dear Jim, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? That was from Peter. That was a question to you about a week ago. You replied, no, 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 Bear Stearns is not in trouble. If anything, they're more likely to be taken over. You were right about that. Well, don't move your money from Bear. Maybe you weren't right about that.
No,
what do you have to say?
Look, let's understand two things. I said the common stock was worthless on Friday, as soon as the thing was at 36, because we then saw a look at the bonds. If you kept your money at Bear, you made out. You got the liquidity. I mean, you know, look, keeping money at Bear was I guess I could have caused a run on the bank and say, take your money out of Bear. I guess people could say, hold it. He's not saying, take your money out of Bear, keep your money in Bear. He's saying, buy the common stock. I mean, what the heck? You want me to say that? I mean, I cannot cause a run. It turned out that the Federal Reserve guaranteed the money. I'm not going to tell people to pull money out of these places. The Federal Reserve's guaranteeing the money. They're just not guaranteeing the equity. I got a lot of things wrong in my life, but I do not regret the fact that I said don't take your money out of Bear. Because if you had your money in Bear, you still got it today. I mean, there's too late. Remember, there's Bear Stearns the common, and that person was asking about whether to pull the money out of Bear. We got a guarantee. J.P. Morgan is now Bear.
Oh, I see. So you're saying if you're if you're someone who had money that Bear was managing, or you're a hedge fund. Okay.
That's what that question was. I came out and said at 36 the stock was worthless, for heaven's sake. No one was saying that.
Right. So your answer to this is, hey, Aaron, I want to make sure everyone understands. I wasn't saying keep your money in Bear common stock.
Do you know what would happen if I came out and said? Do you know what would happen on this show if I came out and said I want everyone to take their money out of X bank? Jim Cramer causes a run on X bank. I mean, that would be stupid, reckless, and wrong because the Fed is guaranteeing it. I mean, we want to play that game. I can give you 5 banks. And I got to tell you, every one of them I wouldn't want to own the common stock, but I would never take a dime out of the vault, for heaven's sake.
All right. So there's enough
problems that Jim Cramer causing a run on X. I'm not going to cause a run on a bank. That's stupid.
Just wanted to give you a chance to respond to this because some people might have interpreted your answer
I didn't cause a run on Bear
common.
I didn't cause a run on Bear. The Bear common stock I didn't like, but keeping your money at Bear turned out to be 100% right. Everybody got guaranteed by the Fed.
Anybody with hedge fund guys, prime brokerage clients.
Every billionaire got bailed out by the Fed. I mean, sorry, I had a prediction that the billionaires would get bailed out.
Joe Lewis doesn't seem so happy.
He owns the common, for heaven's sake. There's the common, and there's the account that you have there. I think the common of most of the large banks is worthless.
For Joe Lewis, I don't know.
I have a lot of my money in a bank that I think is worthless, but I think there's absolutely no doubt that the bank itself will make good on mine.
What bank it is. I know what bank it is. All right. I'm not going to say anything about that bank. Let's talk, please, about JP Morgan.
I don't want to share the bank that I have my money, but I know the FDIC will back it up.
issue of what Goldman Sachs is alleged to have done, of fraud, of selling something when they knew somebody else was making a big bet that it was bad. Joining us, Sylvan Raines, expert in structured finance at R&R Consulting and co-author of the upcoming book, Elements of Structured Finance, due out this May. Jim Cramer and David Favor with us as well. David, let me go to you first because we all heard you asking quite a few of the questions there to Mr. Khuzami. What did you make of his responses, or in fact, to some of your questions, frankly, lack of response?
Yeah, listen, I'm just trying to understand specifically where the SEC believes the fraud was, and I think you got at least some answer there. And just trying to understand how this transaction differed from other synthetic CDO transactions. You've got to remember this market, and I've said this a number of times to you, Aaron, we've talked about it with Jim as well. It's a market that in many ways should never have existed, frankly. You had a $12 trillion physical mortgage market. Why did you need to create a synthetic market for mortgages? Nonetheless, it did exist, and there were a lot of questionable practices that went on in this market in the period of late 2006, early 2007, or all of 2006. We'll see what comes from here. Interesting that the SEC chose Goldman as what I believe will be the first of probably a number of cases. But again, let's wait and see ultimately what happens here. A lot of questions that I don't believe were answered, certainly by Mr. Khuzami in that brief conversation.
Right, and certainly a lot of reasons people could say as to why they would choose Goldman. Jim, let me follow up with you on a comment you made. I don't know if David had a chance to hear you earlier, but David, what Jim was saying was that he had found out that Goldman Sachs itself as a firm was an investor in the Abacus CDO, which is the subject of the fraud complaint today, and they were an investor betting it would go up. So, Jim, is that something that they were in every CDO that they did? Do you have any idea of the size of this investment? Obviously, both important questions to see whether this could help them in their defense.
I have no idea how they were positioned on any other piece of paper other than their Abacus, of which they had about a $90 million investment. Again, I have to ask you, why do they feel so confident? And not smug, but confident. I think they obviously have some facts on their side. If they did have a $90 million investment in Abacus, and I made it very clear that if their information was wrong, I'd just blow their cover immediately. I would have to believe that that's a pretty good piece of information. Let's also not forget that there is no requirement to disclose who is on the other side of the trade. I have often, when I was a hedge fund manager, bought pieces of paper that were clearly meant to be on the other side, a bet against me. And you know what? Such is life. I'm a big institution. Since when do these institutions have some sort of guarantee? These are not little guys who come into the equation blindsided. This is a caveat emptor situation. The German bank, they had billions to be able to do research. What kind of research did they do? I'd like to know.
Sylvan, what do you make of that point? Which is one, as David was making too, if you're coming in on one of these things on one side, you know that the bank setting it up knows there's another side, and in fact is setting it up.
Yes, thank you, Aaron. I'm pleased to be on this show since most of your previous guests were public relations officer for Goldman. Is it okay if I'm a little critical?
I don't like to hear that.
I think that people may take issue with that. I've blasted Goldman many times. I don't need to hear that nonsense.
Oh, Mr. Cramer, I would like to remind you that the word is abacus, not abacus. Now, I'd like to answer the question, Aaron. Is that okay?
Yes, but please don't make any personal allegations at anyone on the show. If you could please
that implies that
refrain
I've taken money from Goldman Sachs. I resent that.
Mr. Cramer, please let me answer. You had your chance.
Take back your charge that I took money, and I will.
Sylvan, go ahead and make your case. Jim will respond.
Okay, it's quite possible that Goldman had an equity position. They probably wrote it off on the closing date. So they stood to lose a few million and to make a few hundred millions. Now, basically, these deals were very complicated. I don't do politics, so I can't comment on the politics of this deal. Goldman Sachs was clearly in the know. They knew what they were doing. In fact, if they're defending themselves against a fraud charge, they would have to make a case that they didn't know, which I think too highly of Goldman Sachs to think that they didn't know what they were doing. Now, if that's the defense that they will, undertake, then so be it. These deals were made to be shorted. We don't have time to go into details. I want to remain shallow in deference to Mr. Cramer.
Hey. I ask you to please not say derogatory things about my colleagues. You can't do that on the show, Sylvan.
Don't give me a hominin nonsense. I wasn't knocking you.
But graciously, thank you.
Yeah, I'm sorry that we can't go into details. These deals were extremely difficult to understand. It's clear that the bank that invested in them did not understand them. Mr. Cramer is correct on this. They should have done their own research. They should not have invested in them, but they did. So in some sense, they're also complicit in this entire scheme. It takes two to tango, and Goldman Sachs probably is just like everybody else trying to make an honest buck on Wall Street. So,
all right, we're going to take a brief break there. We'll be back in just a second. Sylvan will not be with us. Sylvan, you got to be more polite than that. We'll be back in a moment.